Imagine you own a small piece of a business, a real one, with real earnings and real customers, and imagine you have a business partner named Mr. Market. Mr. Market is a strange character. Every single day, without fail, he shows up at your door and offers to either buy your share of the business or sell you more of his. That part's fine, useful even. The strange part is his mood. Some days he's euphoric, practically giddy, and he offers you an absurdly high price for your stake, certain that tomorrow will be even better than today. Other days he's in despair, convinced the business is worthless. The world is ending, and he'll practically give you his share for pennies just to be rid of it. Here's the twist that changes everything about how you're supposed to treat this man. You are never obligated to trade with him. You don't have to sell when he's euphoric. You don't have to buy when he's despairing. In fact, you don't have to pay him any attention at all if you don't want to. He'll be back tomorrow, offering a new price in a new mood, regardless of what you do today. And if you're smart, you'll use his mood swings entirely to your own advantage, buying when his despair has made things cheap, selling when his euphoria has made things absurdly expensive, and otherwise, most days, simply ignoring him. This is one of the most famous allegories in the entire history of financial writing, and it's the doorway into a set of ideas that have quietly shaped how generations of successful investors think about money, including at least one investor who went on to become one of the wealthiest people who has ever lived, and who has said more than once that reading this particular allegory as a young man changed the entire direction of his financial life. That young man was in his 20s when he first encountered these ideas, still years away from becoming a household name, still years away from running an enormous investment company that would eventually be studied in business schools around the world. What struck him wasn't a clever stock pick or a secret formula. It was the temperament the whole framework demanded: patience over excitement, arithmetic over intuition, indifference over anxiety. He would later describe his own investment philosophy as roughly 15% borrowed from a mentor's specific stock-picking techniques, and the rest almost entirely temperament, the ability to sit still while everyone else panicked, and to act calmly while everyone else celebrated. That distinction between technique and temperament turns out to matter more than almost anything else in this entire subject, and it's worth holding on to as a thread running through everything that follows. He would later describe sitting in that classroom as a young man, hearing the Mr. Market allegory laid out for the first time, and feeling something shift permanently in how he understood the entire enterprise of investing. Before that point, he'd approached the stock market the way many bright young people do, treating it as a kind of intellectual puzzle to be solved through cleverness, chart patterns, and a feel for momentum. What he encountered instead was something closer to a discipline of temperament, dressed up in the language of arithmetic, and it reoriented his entire approach for the rest of what would become an unusually long and unusually successful career. Decades later, having built one of the largest fortunes in modern financial history almost entirely through the patient, unglamorous application of these same principles, he would still credit that early exposure to the Mr. Market allegory as the single most important idea he ever encountered about money, more important by far than any individual stock pick or clever trade that followed. Here's why temperament matters so much more than most beginning investors expect. You can hand two people the exact same facts, the exact same spreadsheet, the exact same analysis of a company's earnings and prospects, and they will often reach wildly different real-world outcomes, not because one of them did better math, but because one of them can watch a 40% paper loss without flinching and the other cannot. Information is cheap and has gotten cheaper every decade since this book was first written. Temperament has stayed exactly as rare and exactly as valuable as it always was, because here's the uncomfortable truth sitting underneath the whole allegory. Mr. Market isn't some external character you occasionally deal with. Mr. Market is the market itself, the aggregate mood of millions of other people trading stocks based on fear, greed, headlines, hunches, and herd behavior, and the real danger was never that his prices might sometimes be irrational. The real danger is catching his mood, getting swept up in his euphoria and buying at the top, getting infected by his despair and selling at the bottom. The investor's greatest enemy, it turns out, was never the market itself. It was his own reflection in the market's mood, showing up disguised as his own judgment. The man who first sketched out Mr. Market as a character had lived through one of the most brutal market collapses in modern history himself, as a young professional managing money right as the entire system seemed to come apart at once. He watched fortunes, including some of his own, evaporate within a matter of months. Watched confident, experienced people make catastrophic decisions under the exact same emotional pressure this whole philosophy warns against. That experience didn't push him toward abandoning markets altogether the way it pushed a great many of his contemporaries. It pushed him toward trying to build something more durable than confidence, an actual discipline grounded in arithmetic rather than mood, that could survive being tested by exactly the kind of collapse he just lived through. He spent the following decades teaching this discipline as much as practicing it at a university where a long line of students passed through his classroom, several of whom went on to become extraordinarily successful investors in their own right, carrying his framework forward, adapting it, refining it, but rarely abandoning its core premise. The specific metaphors and case studies from his original writing eventually aged, tied as they were to companies and market conditions from the middle of the last century, and later editions were updated with more current commentary to keep the underlying lessons legible to new generations. But the core ideas, margin of safety, the distinction between investing and speculating, the danger of catching Mr. Market's mood have proven remarkably durable across nearly a century now, surviving one technological revolution after another, one new asset class after another, because the ideas were never really about any specific market condition in the first place. They were about human psychology, which changes far more slowly than markets do. Let's slow down, because there's a distinction buried in here that most people never learn explicitly. And once you see it, you can't unsee it in every financial headline you'll ever read again. There is a difference between investing and speculating, and the difference isn't about which specific asset you're buying, it's about process. An investment operation, properly defined, is one where thorough analysis promises safety of principal and an adequate return. Anything that doesn't meet that bar is speculation, no matter how confident the person doing it feels, no matter how many other people are doing the exact same thing at the exact same time, no matter how reasonable it seems in the moment, because everyone around you seems to be getting rich doing it. This distinction matters more than it sounds like it should, because most financial disasters in history, and there have been plenty of them decade after decade in one form or another, happened not because people were doing something exotic or unusual, but because ordinary people convinced themselves that speculation was investment simply because prices were going up and everyone around them was participating. A rising price by itself tells you almost nothing about whether the underlying analysis supports safety of principle. It only tells you that a lot of people right now, in this moment, are willing to pay more than the last price. That's a fact about crowd psychology. It is not a fact about value. Centuries before modern stock markets existed in anything like their current form, there was a period in one European country where the price of tulip bulbs, an ordinary flower, climbed to levels where a single rare bulb could be traded for a house. Nobody involved thought of themselves as reckless. They thought of themselves as participants in an obviously profitable trend because prices had been rising for months, because their neighbors had already made money, because it seemed in the moment like the safest thing in the world to do was join in rather than be the only person left out. Contracts were bought and sold, not even for the physical bulbs themselves in many cases, but for the mere right to purchase bulbs at a future date, an early and almost comically direct example of speculation layered on top of speculation, several steps removed from anything resembling the actual underlying value of a flower, however lovely that flower might have been. The collapse when it came was swift and brutal, and it left behind a phrase that has outlived almost everything else about the episode. Tulip mania, still invoked centuries later as shorthand for exactly this pattern, rising price mistaken for rising value, crowd participation mistaken for safety. What's striking, looking back at that episode from a distance of several centuries, isn't that people were foolish. Most participants were probably no more foolish than an ordinary person caught up in any modern speculative wave. What's striking is how consistently the same psychological pattern reproduces itself, generation after generation, technology after technology, regardless of how much collective experience humanity accumulates about the dangers of exactly this kind of crowd-driven mispricing. The specific asset changes from era to era. The underlying psychology barely changes at all. Replace tulip bulbs with railway shares in one century, with certain popular stocks in the 1920s, with a wave of internet companies at the turn of the millennium, with various speculative assets in more recent memory, and the shape of the story repeats with almost eerie consistency. Rising price, growing participation, a conviction that this particular instance is different from all the previous instances because of some new technology or new era or new kind of asset that supposedly changes the old rules, and then eventually a return toward whatever the underlying earning power or utility actually supports, usually more abrupt and more painful than anyone celebrating on the way up ever expected. There's a mechanical explanation for why herd behavior spreads so reliably through markets, and it has less to do with individual foolishness than it might seem. Picture a single person, reasonably sensible, watching a price rise for a few weeks. On its own, that observation tells them very little. But now imagine that same person also notices several friends, co-workers, and online acquaintances all participating and all reporting success. Even a fairly skeptical, careful thinker will naturally update their own confidence upward after seeing enough other seemingly sensible people behave a certain way, because relying on the apparent wisdom of a crowd is in most areas of life outside of financial markets actually a perfectly reasonable shortcut. If a restaurant has a long line out the door, that's often decent evidence the food is good. If everyone in your neighborhood is avoiding a particular road, that's often decent evidence there's construction or an accident ahead. Markets are one of the rare arenas where this normally reasonable shortcut breaks down catastrophically, because a crowd buying an asset doesn't produce more of that asset's underlying earning power, the way a crowd at a restaurant might reflect genuinely better food. The crowd's participation is itself the thing driving the price, in a self-reinforcing loop that has nothing to do with the actual value of what's being bought. This is precisely why margin of safety, grounded in arithmetic, rather than in how many other people are doing the same thing, matters so much more in financial markets than the ordinary, generally reliable instinct to trust the crowd's collective judgment. There's an additional wrinkle worth noting, because it makes herd behavior even harder to resist than it might first appear. Standing apart from a crowd during a period of rising prices doesn't just risk missing out on gains. It risks looking foolish in front of people whose opinion matters to you in real time for a sustained period that can stretch on for months or even years before the crowd's mistake finally becomes visible to everyone. An investor who correctly avoided an overpriced, story-driven asset might spend a long, uncomfortable stretch watching friends, colleagues, and online commentators celebrate gains that never materialize for them, and that social discomfort sustained long enough has convinced no small number of genuinely careful investors to eventually abandon their own discipline and join the crowd, often at almost exactly the worst possible moment right before the crowd's mistake finally comes due. Which brings us to the concept sitting at the very center of everything else in this philosophy. The one idea that, if you remember nothing else, changes how you look at every investment decision for the rest of your life: margin of safety. Here's the idea in its simplest form. Every business, every stock, has some estimate of what it's actually worth, its intrinsic value, based on its earnings, its assets, its prospects, and separately, it has a price, which is whatever the market happens to be charging for it today. Those two numbers are rarely the same. Sometimes the price is far below the estimated value, because Mr. Market is having a bad day or a bad year, or because an entire industry has fallen out of favor for reasons that have nothing to do with any specific company's actual earning power. Sometimes the price is far above the estimated value, because Mr. Market is euphoric, because a story has captured the public imagination, because everyone wants in and nobody wants to be the one left out. The margin of safety is the gap between price and value. And the entire philosophy boils down to this: only buy when that gap is meaningfully in your favor, when you're paying substantially less than what the thing is actually worth, so that even if your estimate of value turns out to be a little too optimistic, even if something unexpected goes wrong, you still have cushion. You still come out fine. It's the financial equivalent of a bridge engineer designing a structure to hold far more weight than it will ever actually need to carry. Not because the engineer expects the maximum load every single day, but because building in that cushion is what separates a bridge that survives an unexpected surprise from one that collapses the first time reality deviates even slightly from the plan. Picture a concrete example, stripped down to simple numbers, so the idea is impossible to miss. Suppose careful analysis of a company's earnings, assets, and prospects suggests it's genuinely worth around $100 a share. If the market happens to be selling it for $95, you technically have a margin of safety, but a razor-thin one, barely any cushion, if your estimate turns out to be a little too generous. If instead the market is selling it for $60, your margin of safety is enormous. Even if your estimate of value was overly optimistic by a meaningful amount, even if something unexpected goes wrong with the business, you still have a substantial cushion between what you paid and what the thing is genuinely worth. The bigger that gap, the more room there is for you to simply be wrong about some of the details and still come out fine in the end. Now, flip the picture around. Suppose that same $100 company is trading at $180 because Mr. Market has grown euphoric about its prospects, because a compelling story about its future has captured everyone's imagination, because analysts keep raising their price targets in a kind of feedback loop where optimism justifies more optimism. At that price, there is no margin of safety at all. There's a margin of danger instead, a gap between price and value, running in exactly the wrong direction. And buying at that price means betting not on the company's actual earning power, but on the hope that Mr. Market's mood stays euphoric long enough for someone even more optimistic to come along later and pay you even more than you paid. That's not investing. That's speculation wearing an investor's clothing. Think about how radically this reframes the entire emotional experience of investing. Most people feel afraid when prices fall and excited when prices rise. Under this framework, that instinct is almost exactly backwards. A falling price on something whose underlying value hasn't actually changed isn't bad news. It's an opportunity, a widening margin of safety, a chance to buy the same business, the same earnings, the same future, for less money than yesterday. A rising price, especially a rapid one, untethered from any actual change in earnings or prospects, isn't necessarily good news either. It might just mean the margin of safety is shrinking, or has vanished entirely, or has gone negative, meaning you'd now be paying more than the thing is actually worth, trusting only that someone even more optimistic will come along later and pay you even more. This is, in a very real sense, the exact opposite of how most untrained instinct wants to behave around money. And that gap between instinct and correct behavior is where almost every investing mistake in history has been born. Now, there's a practical question that follows naturally from all of this, and it's one the whole philosophy takes seriously rather than brushing aside. What kind of investor are you actually capable of being honestly given your own temperament, your available time, and your appetite for the work involved? Two broad types get described, and neither one is presented as superior to the other. They're simply different paths suited to different people. And the honest thing to do is pick the one that matches who you actually are, rather than who you'd like to imagine yourself to be. The defensive investor is someone who wants a sound, reasonably profitable outcome without spending much time or energy on it, and without exposing themselves to serious error or worry along the way. This isn't a lesser path. It's arguably the wiser one for the vast majority of people, precisely because it doesn't ask you to become an expert, doesn't ask you to check prices daily, doesn't ask you to trust your own judgment in moments of market euphoria or despair. The defensive investor's strategy leans on broad diversification, a sensible split between stocks and high-quality bonds, and a refusal to chase whatever happens to be exciting at the moment. It's a strategy built for people who have full lives, full careers, full families, and simply don't want investing to become another job on top of everything else. The enterprising investor, by contrast, is someone willing to put in real time and real effort, analyzing individual businesses, digging into financial statements, understanding an industry deeply enough to judge whether a given price represents a genuine margin of safety or a trap dressed up to look like one. This path can, in principle, produce better results than the defensive path, but only for someone genuinely willing to do the work. And honestly, that's a much smaller group of people than the number who believe they belong to it. A huge number of investing disasters throughout history have come from people who believed they were enterprising investors, doing careful analysis, when in fact they were simply speculating with extra steps, mistaking enthusiasm for rigor. There's a middle ground worth naming too, because not every defensive investor wants to hold individual bonds and individual stocks directly, tracking each one, rebalancing by hand, a broad, low-cost fund that simply owns a wide slice of the entire market, hundreds or even thousands of businesses at once, spanning nearly every industry, accomplishes almost everything the defensive philosophy asks for in a single purchase without requiring any individual company analysis at all. You're no longer betting on any single business's fortunes. You're betting on the collective earning power of an entire economy, continuing to grow the way it has, in aggregate, across every previous decade of modern economic history, even though any individual year along the way might look turbulent, frightening, or downright ugly. This is, in a sense, the most defensive version of the defensive path, and it deserves more respect than it usually gets, because it sounds almost too simple to be taken seriously by anyone who wants to feel clever about their money. There's no stock-picking prowess required, no hours spent reading annual reports, no temptation to believe you've spotted something the rest of the market has somehow missed. Just broad ownership, automated contributions, and the patience to let decades of aggregate economic growth do the heavy lifting instead of any individual act of cleverness. Here's a question worth sitting with, because it cuts right through a lot of financial ego. Which one are you, honestly? Not which one sounds more impressive at a dinner party. Which one matches how much time you're actually willing to spend, month after month, year after year, reading annual reports and financial statements, instead of doing literally anything else with that time. Most people, if they're being truthful with themselves, are defensive investors, whether they admit it or not, and there is no shame whatsoever in that. The defensive path, done consistently over decades with genuine discipline, has built enormous wealth for enormous numbers of perfectly ordinary people who never once picked an individual stock in their lives. There's a particular kind of mistake worth naming here. One that has nothing to do with picking the wrong companies and everything to do with picking the wrong version of yourself to be. Picture someone with a demanding career, a young family, and maybe 2 or 3 hours a week of genuine free time, who nonetheless decides they're going to be an enterprising investor because a friend made impressive returns, picking individual stocks, or because a certain kind of financial content online makes stock picking look glamorous, fast-paced, and intellectually exciting in a way that broad, boring diversification simply never will. They open individual positions in a handful of companies, intending to follow each one closely, read each earnings report, track each competitor. For the first few months, enthusiasm carries them. Then the demanding career reasserts itself. The young family needs attention. The 2 or 3 hours a week quietly evaporate, and the enterprising portfolio starts drifting on autopilot anyway, except now it's an undiversified, unmonitored collection of individual bets, rather than a deliberately diversified low-maintenance foundation. This isn't really an enterprising strategy that failed. It's a defensive investor's actual life circumstances, dressed up in an enterprising investor's strategy, which is a mismatch that tends to produce the worst qualities of both paths at once: the concentration risk of stock picking without the sustained analysis that's supposed to justify it. The honest fix isn't more willpower or a renewed commitment to read more annual reports next quarter. It's an honest inventory of the life you actually have, not the one you'd like to imagine having more spare hours inside of, and a willingness to choose the defensive path not as a consolation prize, but as the genuinely correct strategy for someone with your actual real constraints. There's a quieter version of this same mismatch that shows up even among people who never intended to pick individual stocks at all. It happens when someone chooses an asset allocation, a mix between stocks and bonds, based on how brave they feel reading about it on a calm, uneventful day, rather than how they're likely to actually feel in the middle of a genuine downturn. An allocation that looks perfectly reasonable on a spreadsheet on a quiet afternoon, with no real money on the line, yet can feel completely unbearable once an actual decline of 30 or 40% arrives, and a very real portion of a person's life savings is visibly, painfully smaller than it was a few months earlier. The honest question isn't simply what allocation produces the best theoretical long-term return, it's what allocation you can genuinely stick with without panicking and selling through an actual severe downturn. Because an aggressive allocation abandoned in a moment of panic will almost always produce a worse real-world outcome than a more conservative allocation that gets held steady the entire way through. For anyone genuinely drawn to the enterprising path, it's worth walking through briefly what the actual work looks like, because it's less mysterious than it sounds and considerably more tedious than most people expect going in. It starts with reading not headlines, not opinions, but a company's own financial statements. The income statement showing what it earned and spent, the balance sheet showing what it owns and what it owes, and the cash flow statement showing where money actually moved, which sometimes tells a very different story than the income statement alone suggests, because accounting earnings and actual cash in the door aren't always the same thing. A few figures tend to matter more than most. There's the price-to-earnings ratio, a simple comparison between what you'd pay for a share and how much profit that share represents on an annual basis. A rough, imperfect, but genuinely useful shorthand for whether a price looks reasonable relative to the earnings backing it up. There's the debt level relative to the company's assets and earnings, because a business loaded with debt is a business with far less room to survive a bad year, since debt payments don't pause just because revenue temporarily drops. There's the consistency of earnings over many years, not just the most recent quarter, because a single great quarter tells you far less than a decade of steady, gradually growing profit does about whether a business has a durable, repeatable way of making money. Picture two companies in the same industry, similar size, similar revenue, One carries very little debt, funding most of its operations and growth out of its own steady profit. The other has taken on substantial borrowing to expand faster, betting that growth will outpace the cost of servicing that debt. In a good year, the more indebted company might actually show more impressive percentage growth in profit because debt used well can amplify returns the same way leverage amplifies an individual investor's gains. But in a bad year, a recession, a sudden drop in demand, a disruption in the industry, the company with heavy debt faces fixed interest payments regardless of how much revenue has fallen, while the company with little debt has far more room to absorb a bad stretch without being pushed toward real financial distress. A careful analysis of debt levels isn't about avoiding all borrowing on principle. It's about understanding how much cushion a business actually has before an ordinary bad year turns into something closer to a crisis. There's a concept that emerged later, built by one of the philosophy's most famous students, that captures something the original framework only implies rather than states outright: the idea of a circle of competence. The idea is simple enough to state in a single sentence, though genuinely difficult to practice with honesty. Every investor, no matter how experienced, has some boundary around what they actually understand deeply enough to judge intelligently, and the size of that circle matters far less than knowing honestly where its edges are. A retired school teacher might understand the economics of education funding, retail consumer habits, and household budgeting better than most professional analysts simply from decades of direct lived experience, while knowing almost nothing useful about semiconductor manufacturing or biotechnology patents. That's not a limitation to be embarrassed about, it's a fact to be respected. Because the investors who get into the most trouble aren't usually the ones with small circles of competence. They're the ones with small circles who convince themselves, usually under the influence of an exciting story or a friend's enthusiasm, that their circle is larger than it actually is. Staying inside your circle of competence doesn't mean staying inside a single industry forever, and it doesn't mean refusing ever to learn something new. It means being honest in the moment of making a decision about whether you actually understand the specific business you're evaluating well enough to judge its intrinsic value with any real confidence, or whether you're mostly just borrowing someone else's confidence, a headline's confidence, a friend's confidence, and mistaking that borrowed feeling for genuine understanding of your own. Consider how this plays out with something as ordinary as a favorite consumer brand. Loving a company's products, using them daily, feeling genuine brand loyalty toward them tells you almost nothing reliable about whether that company's stock, at its current price, offers a genuine margin of safety. Plenty of beloved, well-run, widely admired companies have still been overpriced investments at various points in their history, precisely because everyone else loved the products too, and that widespread affection pushed the price up well beyond what the underlying earnings could justify. Genuine understanding of a business for investment purposes means understanding its numbers, its competitive position, and its prospects for sustaining or growing its profits, not simply enjoying what it sells. Confusing consumer enthusiasm with investment analysis is one of the more common and most forgivable mistakes a beginning investor makes, precisely because it feels in the moment like genuine insight rather than borrowed enthusiasm. None of this requires genius-level intelligence. It requires patience and a willingness to read documents that are, frankly, often written in dense, unglamorous language that seems almost deliberately designed to discourage casual reading. This is precisely why the enterprising path is described as one requiring real time and real effort, and precisely why so many people who believe they're pursuing it are actually skipping the tedious parts, reading a headline or a summary or a friend's confident opinion instead, and calling that analysis. Real analysis is slower and far less exciting than that. It rarely produces a dramatic story worth repeating at a dinner party. It just produces over time a somewhat more reliable read on whether a given price actually reflects a genuine margin of safety. There's a related danger worth naming here, one that specifically targets people who've done just enough research to feel confident without having done enough to actually be right. It's a form of overconfidence, and it tends to strike hardest in people with some genuine expertise in an adjacent field. An engineer who feels certain they understand a technology company because they understand the technology, a doctor who feels certain about a pharmaceutical stock because they understand the medicine, a marketer who feels certain about a consumer brand because they understand the advertising. Domain expertise in one area creates a dangerous illusion of expertise in an entirely different question, not whether the underlying product or technology is good, but whether the current price already reflects more optimism about that product or technology than the actual numbers can support. Plenty of genuinely excellent, genuinely important businesses have still been terrible investments at the wrong price, and plenty of mediocre businesses have been excellent investments at a sufficiently low one. Understanding the product was never the same skill as understanding the margin of safety. Let's go back to Mr. Market for a moment because his mood swings deserve a deeper look, and there's a piece of human psychology hiding inside them that shows up again and again throughout financial history, dressed up in different costumes every single time. Picture a market convinced that a particular industry can only go up. It's happened with railroads. It's happened with radio. It's happened with real estate in more than one country, more than one decade. It happened, memorably, with a wave of internet companies at the turn of the millennium. Businesses with barely any revenue and no clear path to profit bid up to valuations that made no sense under any reasonable analysis of intrinsic value, purely because Mr. Market, in one of his most euphoric moods in modern history, had convinced an enormous number of otherwise sensible people that the old rules simply didn't apply anymore, that this time really was different. It wasn't different. It's never actually different, not in the way the euphoria insists it is. What happened next, as it almost always does, was a painful reset, prices crashing back towards something resembling actual earning power. And a great many people who had convinced themselves they were investing when they were in fact speculating on momentum and a story learned the distinction the hard way. Picture an ordinary investor during that period, someone with a stable job, a family, no particular background in finance, who watched coworkers and neighbors seem to get rich almost overnight buying shares of companies whose names ended in a certain trendy suffix, companies that in many cases had never once turned a profit and had no clear plan for how they ever would. The pressure to participate wasn't really about greed in the cartoonish sense. It was about something much more human and much harder to resist. The fear of being the only person left out of something everyone around you seems to be benefiting from. That specific fear has a name in behavioral circles, the fear of missing out, and it has probably destroyed more household savings throughout financial history than outright greed ever has, because it doesn't feel like greed while it's happening. It feels like common sense, like simply not being foolish enough to sit on the sidelines while the world moves on without you. When the reset came, it came fast, and it came for the companies with the least substance first, the ones whose price had been built almost entirely on story and momentum, rather than any actual margin of safety. Many of those companies simply ceased to exist within a couple of years. The investors who had piled in near the top, infected by the fear of missing out, watched paper fortunes evaporate in a matter of months. Meanwhile, investors who had stuck to the boring, unglamorous discipline of buying real earning power at a real discount to value largely rode out the same period with far less drama, precisely because they had never been playing the same game in the first place. A more recent version of this same pattern played out in a completely different setting decades later on online forums and social media. where a coordinated wave of retail traders drove the price of a handful of struggling, unremarkable companies to levels that bore almost no relationship to anything in their actual financial statements. The appeal wasn't really about a careful read of intrinsic value. It was about momentum, community, a shared story about beating larger, more established institutional investors at their own game, and the genuine thrill of watching a number climb rapidly while everyone in the same online community celebrated together. For a while, some of the earliest participants made real money, and their success, publicized, loudly pulled in wave after wave of later participants right up the classic pattern this whole philosophy warns about. Price disconnected from value, sustained purely by the expectation that the price would keep climbing, because it had been climbing. The specific technology was new. Online forums didn't exist when this book was first written. The psychology underneath it was not new at all. It was the same fear of missing out, the same crowd-driven euphoria, the same mistaking of a rising price for a rising value, dressed up in a completely modern costume. Some of the latest arrivals to that particular wave, buying near the very top out of a fear of being left behind, ended up holding positions worth a small fraction of what they'd paid once the wave inevitably receded. The lesson wasn't really about that specific handful of companies. It was the same lesson this entire philosophy keeps returning to in era after era, technology after technology. A crowd's enthusiasm is not the same thing as a business's earning power. No matter how modern or how communal or how technologically novel the crowd's method of expressing that enthusiasm happens to be. And here's the part that matters most for anyone listening to this who isn't a professional trader glued to a screen all day. The people who suffered the worst outcomes in that collapse, and others like it, throughout history, weren't usually the people who bought early and held on. They were, disproportionately, the people who bought late, near the euphoric peak, infected by Mr. Market's mood rather than immune to it, and then panicked and sold near the bottom, infected once again by his despair on the way down. They caught the mood swing in both directions, which is close to the worst possible outcome available in the entire universe of financial mistakes. Buy high because everyone else is buying, sell low because everyone else is selling. It's a strategy, in a sense, just an almost perfectly wrong one. The alternative isn't heroic. It isn't about having perfect foresight or timing the market with any precision, because nobody can reliably do that. Not professionals, not amateurs, not anyone, no matter what they claim after the fact, once they've gotten lucky once or twice. The alternative is simpler and far less glamorous. It's about having a process, a set of principles about margin of safety and intrinsic value, and sticking to that process regardless of Mr. Market's mood on any given day, which means sometimes doing nothing at all for long stretches, buying steadily and patiently when conditions are reasonable, and specifically resisting the powerful gravitational pull toward euphoria or despair whenever the crowd around you succumbs to either one. There's a mechanism that helps enormously with this, one that ties directly into a theme that should sound familiar if you've been listening to anything else on this channel about automatic systems replacing willpower: dollar-cost averaging. The idea is straightforward. Instead of trying to guess the perfect moment to invest a lump sum, an exercise that even professional fund managers fail at consistently decade after decade despite armies of analysts and unlimited access to data, you simply invest a fixed amount on a fixed schedule automatically, regardless of whether prices are up or down that particular week or month. Picture putting $200 into an investment every single month for a year, regardless of price. In a month where shares cost $20 each, that $200 buys 10 shares. In a month where panic has driven the price down to $10 a share, that same $200 now buys 20 shares instead, twice as many, purely because the price dropped and your contribution stayed fixed. In a month where euphoria has pushed the price up to $40, your $200 only buys 5 shares, over the full year without you ever having to decide which months felt like good months to invest. You've automatically bought more shares during the cheap months and fewer during the expensive ones, which means your average cost per share ends up lower than the simple average of the monthly prices themselves. The math does the buying low, selling high instinct for you mechanically, without requiring you to correctly predict a single one of those price swings in advance. When prices are low, your fixed contribution buys more shares. When prices are high, it buys fewer. Over time, this smooths out the wild unpredictability of Mr. Market's moods, and more importantly, it removes the single most dangerous variable in the entire equation, your own emotional judgment about timing. You are no longer required to decide whether today is a good day to invest, which means you're no longer vulnerable to the very human tendency to feel most excited about investing exactly when euphoria has made prices least attractive and most reluctant to invest exactly when despair has made prices most attractive. The automation does the emotionally difficult work for you, the same way an automatic retirement contribution does the disciplined saving for you before your present biased brain ever gets a vote. There's a related habit worth naming and specifically avoiding, one that shows up constantly in financial media and tempts even careful, disciplined investors: the forecast. Predictions about where the broad market will be in 6 months, in a year, by the end of the current cycle, delivered with total confidence by people whose job, in a very real sense, depends on sounding confident regardless of whether their track record actually supports that confidence. It's worth knowing plainly that the track record of professional short-term market forecasting taken in aggregate across decades of predictions from countless well-credentialed analysts is genuinely poor, often barely better than random guessing, and sometimes measurably worse once you account for how confidently wrong predictions tend to be delivered. This isn't a knock on the intelligence of the people making those predictions. Markets are influenced by an almost uncountable number of interacting variables: interest rates, corporate earnings, geopolitical events, shifts in consumer sentiment, technological change, and plain irreducible randomness. And no amount of intelligence or data reliably untangles that many moving parts far enough in advance to predict short-term price movements with any consistency. The entire margin of safety philosophy sidesteps this problem almost entirely by refusing to depend on short-term forecasting in the first place. You don't need to predict what the market will do next month if your process is built around a long-time horizon, a genuine cushion between price and value, and the patience to simply wait, rather than needing to be right about short-term timing at all. Track the same handful of confident annual predictions across enough years, and a pattern emerges that's almost comic in its consistency. The specific number predicted is usually wrong, sometimes wildly so, and yet the following year brings an entirely new prediction, delivered with exactly the same confidence as the last one, with little apparent cost to the forecaster's credibility or continued media presence. This isn't a criticism of any individual forecaster so much as an observation about the entire genre of short-term prediction itself. The demand for confident-sounding forecasts about an inherently unpredictable near-term future never goes away, regardless of how consistently those forecasts fail to materialize, which tells you something important about why they keep getting made in the first place, and why a disciplined investor is generally better off tuning them out entirely rather than trying to sort the rare accurate ones from the far more numerous inaccurate ones in real time. This is, in its own quiet way, one of the more liberating ideas in the whole philosophy. You are explicitly permitted to have no opinion whatsoever about what happens next month, and your investment process doesn't require you to have one. Let's talk about diversification for a moment, because it's one of those pieces of advice that's repeated so often, it stopped sounding like it means anything, the way eat your vegetables stops registering as actual advice once you've heard it 1,000 times. The reasoning behind it is simple, almost embarrassingly so, once you see it clearly. No matter how careful your analysis, no matter how deep your research into a particular business, you cannot eliminate the possibility of being wrong. Markets are complex. Businesses face competitors, technological shifts, regulatory changes, leadership failures, and outright fraud that no amount of outside analysis can always detect in advance. A single investment, no matter how promising it looks on paper, carries a risk that a broad basket of investments simply doesn't carry in the same way, because the basket's fortunes don't all depend on one company's single roll of the dice. There's a particular kind of story that shows up again and again in financial history. Different names and different decades attached to it, but always the same shape. An employee at a large, seemingly stable company spends years accumulating company stock, often through a retirement plan that made it easy and automatic to do so, until an enormous share of their entire net worth is tied up in the fortunes of that single employer. It feels safe because the company feels familiar, because the employee sees it every day, believes in it, understands it better than some abstract fund full of businesses they've never heard of. Then something goes wrong, an accounting scandal, a shift in the industry, a failure of leadership, and the stock collapses, sometimes to nearly nothing, within a matter of weeks. The employee doesn't just lose a chunk of their savings. In some of the more painful versions of this story, they lose their job at almost exactly the same time, because the same collapse that destroyed the stock also destroyed the business that was paying them, meaning their income, and their savings failed together for the same underlying reason at the same moment. That's the specific danger diversification is built to prevent. Not just the risk of being wrong about one company, but the risk of tying too many different parts of your life to the fortunes of that single company at once. This is why the defensive investor's path so often leans toward broad, diversified holdings rather than concentrated bets on a handful of individual companies. It's not a lack of conviction. It's a recognition of the limits of anyone's ability to be certain about the future, no matter how much research they've done, no matter how many years of data they've studied. Even the most skilled analysts in history have been wrong, sometimes catastrophically, about individual companies they were deeply convinced of. Diversification doesn't guarantee you'll never lose money. It guarantees that no single mistake, no matter how badly it turns out, can sink the entire portfolio. Now, here's a story worth sitting with, because it illustrates almost everything discussed so far in a single, compact arc. Picture two investors starting on the exact same day, with the exact same amount of money, buying into the exact same diversified basket of investments. One of them checks the price every single day, watches financial news obsessively, feels a jolt of anxiety every time the market dips even slightly, and a rush of excitement every time it climbs. Over the following 20 years, this investor sells during two separate downturns, convinced each time that things were only going to get worse, and buys back in later, after prices have already recovered significantly, because that's when it finally felt safe again to get back in. Each time they buy high and sell low, precisely backwards, precisely the outcome Mr. Market's mood swings are designed to tempt anyone into. The second investor does something almost boring by comparison. They set up an automatic contribution, the same amount every single month, regardless of headlines, regardless of whether the market had a terrible week or a wonderful one. They don't check the price daily. They don't watch financial news obsessively when the market crashes, which it does more than once over that 20-year stretch, because markets always eventually do. They don't panic, because they were never checking closely enough to panic in the first place, and because their process had already decided in advance that downturns were buying opportunities rather than emergencies. 20 years later, these two investors, who started on the exact same day with the exact same amount of money, end up in dramatically different places. Not because the second investor was smarter, or had access to better information, or picked better individual investments, because the second investor never let Mr. Market's mood become their own mood. The first investor's problem was never a lack of intelligence. Both investors in this story are equally capable, equally informed, reading the exact same news. The only difference is the first investor let a fictional business partner's daily emotional temperature dictate real decisions over and over again, while the second investor simply refused to check his temperature at all. Walk through the two downturns in that 20-year stretch a little more slowly, because the specific mechanics of where the damage happened matter. In the first downturn, prices across the broad market fall by roughly a third over the course of a difficult year, driven by a genuine economic slowdown, real job losses, real uncertainty about the future. The first investor, checking prices daily, watching the number in their account shrink week after week, eventually reaches a breaking point somewhere near the bottom, when the fear feels unbearable and every headline sounds like confirmation that things will only get worse from here. They sell, converting a paper loss into a real permanent one, and move the proceeds into cash, telling themselves they'll get back in once things feel safer again. The recovery, when it comes, doesn't arrive with a helpful announcement. It happens quietly, unevenly. And by the time it feels safe enough for the first investor to get back in, prices have already climbed most of the way back toward where they started, meaning the first investor has locked in the fall and missed a meaningful chunk of the recovery, the exact worst combination available. The second investor, meanwhile, having never sold and having kept their automatic monthly contribution running the entire time, actually bought some of their cheapest shares of the entire 20-year period during the worst weeks of that downturn, without ever consciously deciding to be brave, simply because the automation didn't know to be afraid. The second downturn years later plays out along nearly identical lines, and the first investor, having learned nothing structural from the first experience beyond a vague resolution to be more careful next time, repeats almost exactly the same pattern, selling into fear, waiting for a feeling of safety that only arrives after much of the recovery has already happened, buying back in at a higher price than where they sold. Two downturns, two repetitions of the same costly mistake, and neither one required bad luck or bad information. Both required only a normal, deeply human reaction to fear, unfiltered by any process designed specifically to override it. This gets at perhaps the single most quietly devastating idea in the entire philosophy, one worth repeating, because it cuts against almost everyone's instinct. The investor's chief problem, and even his worst enemy, is likely to be himself. Not the market, not the economy, not bad luck. The greatest threat to almost anyone's long-term financial success is their own reaction to short-term volatility, their own susceptibility to Mr. Market's contagious moods, their own tendency to mistake a temporary price swing for a permanent verdict on the underlying value of what they own. There's a related idea worth exploring here, something that applies just as much to picking individual investments as it does to reacting to their price swings: the danger of certainty, especially borrowed certainty, the kind that comes from a confident voice on a screen or a friend who made money on something last year and now speaks about it with total authority. Financial history is littered with examples of confident predictions that turned out to be spectacularly wrong, made by people whose confidence had nothing to do with their actual accuracy. Confidence and correctness are not the same thing, and one of the quieter skills this whole philosophy tries to instill is a kind of productive humility, an acceptance that nobody, including you, including the most celebrated analyst on television, can predict short-term market movements with any real reliability, and that the entire premise of a sound investment strategy has to be built on something more durable than anyone's ability to guess what will happen next month or next year. Consider the opposite of an exciting, story-driven company for a moment, because the philosophy's favorite hunting ground has always been the unglamorous rather than the thrilling. Picture a company that makes something unremarkable: industrial parts, basic household goods, something nobody would ever bring up at a party as an exciting investment idea. It has steady, boring earnings, decade after decade modest growth, nothing that would ever generate an excited headline. Because it's boring, because it doesn't tell an exciting story. Mr. Market often prices it well below what careful analysis suggests it's genuinely worth, simply because there's no crowd of excited buyers pushing the price up the way there is for whatever the current exciting story happens to be. That gap between an unglamorous steady earning power and an unglamorous undervalued price is precisely where a margin of safety investor tends to find the most reliable opportunities, not in the companies making headlines, but in the companies too boring for headlines to bother with in the first place. There's an uncomfortable psychological cost to this approach worth naming honestly, because pretending it doesn't exist would be dishonest. Buying boring, unglamorous companies while everyone around you is excitedly discussing whatever thrilling story is currently capturing the market's imagination requires a kind of social discomfort that shouldn't be underestimated. It can feel, for long stretches, like you're missing out, like everyone else is smarter or braver or simply having more fun with their money than you are. This discomfort is not a sign that the approach is wrong. It is, if anything, part of the mechanism that keeps the approach working at all. Because if buying boring, undervalued businesses ever became exciting and popular, the crowd's enthusiasm would push the price up until the margin of safety vanished, the exact same fate that eventually befalls every exciting story once enough people pile in. There's a useful reframe here that some patient investors find helpful for tolerating that discomfort over time. Boredom, in this specific context, isn't a bug. It's closer to a feature, almost a filter, screening out exactly the crowd whose enthusiasm would otherwise compete away the very discount that makes the opportunity attractive in the first place. A business genuinely too dull to attract excited buyers is, in a strange way, protected by its own dullness, at least for a while, right up until something changes, either in the business itself or in whatever story the broader market happens to be telling itself that particular season. That's why intrinsic value matters so much more than short-term price movement in this entire framework. Intrinsic value is grounded in something real and knowable, at least in rough terms: a company's earnings, its assets, its competitive position, its capacity to keep generating profit over time. Price, especially short-term price, is grounded in something far less stable: the collective mood of millions of people trading against each other, some informed, many, not some patient, many not. All of them influencing a number that can swing wildly in a single afternoon for reasons that often have nothing whatsoever to do with any actual change in a company's underlying business. Let's bring in one more contrast, because it's worth naming directly. The difference between price and value shows up just as starkly at the level of an entire market as it does for a single company. There have been entire historical periods where broad market prices climbed to levels that, by almost any reasonable measure of underlying earnings, looked disconnected from reality. The late 1920s, certain stretches of the late 1990s, various property markets in various countries at various points. In every case, the pattern rhymes even when the specific details differ. Prices climb, driven increasingly by the expectation that prices will keep climbing rather than by any change in underlying value. More people pile in because everyone around them seems to be getting rich, and eventually the gap between price and reality becomes too wide to sustain, and it closes often abruptly, often painfully for anyone who mistook a mood for a fact. None of this means avoiding markets altogether, and this is an important point that sometimes gets lost when this cautionary story gets told. The lesson was never the market is dangerous, stay away. Markets, over long stretches of history, have been one of the most powerful wealth-building tools available to ordinary people, precisely because businesses in aggregate tend to grow, innovate, and generate real earnings over time. The lesson is narrower and more useful than blanket avoidance. Know the difference between participating in that long-term growth through a sound disciplined process and getting swept into short-term speculation dressed up to look like investing because everyone else is doing it and prices are going up. There's a specific piece of advice that emerges from all of this, almost like a compressed summary of the entire philosophy, and it's worth holding on to. In the short run, the market behaves like a voting machine tallying up popularity, sentiment, and mood, moving on stories and feelings and headlines that will be forgotten within a year. In the long run, the market behaves like a weighing machine, and what it weighs, ultimately, is real earning power, real value, real substance. Short-term price is a popularity contest. Long-term price is a referendum on reality. And the entire discipline of sound investing is about anchoring your decisions to the weighing machine, patiently, even while the voting machine screams something different every single day. There's a distinction worth drawing out explicitly here because collapsing it is where so much unnecessary panic comes from. The difference between a paper loss and a permanent loss. When the price of something you own falls and you haven't sold it, you haven't actually lost anything yet in any final sense. You're holding an asset that's currently valued lower by Mr. Market's current mood, but the loss only becomes real, permanent, and irreversible at the exact moment you sell. This sounds almost too simple to be worth saying out loud, and yet it's astonishing how many real financial disasters trace back to exactly this confusion, treating a temporary on-paper decline as though it were already a final verdict, and reacting to it as such by selling, which is the one action that actually converts a recoverable dip into an irreversible loss. Look back across a full century of market history and a pattern emerges with almost monotonous consistency. Every single severe downturn, without exception, has eventually been followed by a recovery to new highs given enough time. Some recoveries took a couple of years. Some took the better part of a decade. None of them took forever, though it's worth being honest that living through the middle of one, without the benefit of hindsight, feels nothing like a guaranteed temporary dip. It feels, in the moment, exactly like the world ending, which is precisely why so many people sell right in the middle of it, converting what history shows was almost always a temporary paper loss into a permanent realized one. This is why time horizon matters so enormously to how much risk any given investor can reasonably afford to take, and why the exact same downturn can be a minor inconvenience for one investor and a genuine catastrophe for another, depending entirely on when they need the money. Someone decades away from needing their invested savings can treat even a severe multi-year downturn as a temporary paper loss, patiently waiting out the recovery that history suggests, though never guarantees, will eventually come. Someone who needs that same money next year to buy a house, to pay for a wedding, to cover a known upcoming expense, doesn't have that luxury of time, and for that person, a severe downturn arriving at the wrong moment could force a genuinely permanent loss simply because the calendar didn't allow for patience. This is exactly why money needed in the near term generally has no business sitting in volatile investments in the first place, no matter how compelling the long-term case for those investments might otherwise be. The margin of safety concept applies just as much to timing as it does to price. This naturally raises a question that deserves a direct answer rather than a vague gesture toward patience. If you're not supposed to sell out of fear during a downturn, when, if ever, does selling actually make sense? The honest answer has almost nothing to do with the price movement itself, and almost everything to do with whether the original reasons for owning something have changed. If a company's underlying earning power has genuinely deteriorated, if its competitive position has eroded, if the actual business, not just its stock price, has become meaningfully worse than it was when you first bought it, that's a legitimate reason to reconsider regardless of whether the price has risen or fallen since. but a price falling purely because Mr. Market has grown fearful, with no corresponding change in the business itself, is not on its own a reason to sell. It's often, in fact, closer to a reason to consider buying more, provided the original margin of safety analysis still holds. This distinction between selling because the business has changed and selling because the price has changed sounds subtle, but turns out to be one of the most practically useful filters available to any investor trying to figure out in the middle of a stressful week whether their current instinct to sell is coming from genuine analysis or from simple contagious panic. This is why the defensive investor's simple approach, broad diversification, a sensible mix of stocks and bonds, automated and consistent contributions, minimal trading, and a near-total refusal to react emotionally to daily price movements, has over long stretches of financial history actually outperformed a huge number of far more sophisticated, far more active strategies pursued by people who spent enormous amounts of time and energy trying to outsmart Mr. Market's daily mood swings. It sounds almost insulting to how much effort those more active strategies require. And yet the data, across decade after decade, tells a remarkably consistent story. Patience, discipline, and a refusal to be emotionally hijacked by short-term volatility beats cleverness far more often than cleverness would like to admit. There's one more danger worth naming explicitly because it turns an ordinary bad year into a genuine catastrophe, and it has nothing to do with picking the wrong company. It's leverage, borrowed money used to amplify an investment position beyond what your own savings alone would allow. On paper, leverage looks like a shortcut to bigger returns, and when Mr. Market is in a generous mood, it can indeed produce bigger returns, which is exactly why it tempts so many otherwise careful people into using it. But leverage doesn't just amplify gains, it amplifies losses in exactly the same proportion, and worse, it introduces a danger that a purely cash-funded investor never has to face at all: the possibility of being forced to sell at the worst possible moment, not because you chose to, but because a lender requires it. Right in the middle of one of Mr. Market's despairing episodes, at exactly the moment when prices are lowest and your margin of safety, if you even still had one, has already been wiped out. An unleveraged investor with a genuine margin of safety can simply wait out even a severe downturn patiently. For however long it takes for prices to recover, a leveraged investor often doesn't get the luxury of waiting at all. There's a particular version of this story that repeats throughout financial history right up through the collapse of the late 1920s, when a great many otherwise sensible people had borrowed heavily to buy stocks, often putting up only a small fraction of the purchase price themselves, and financing the rest, convinced that the rising trend would continue long enough to pay off the loan and pocket the difference when prices began falling instead. Those loans came with a brutal mechanical feature. As the value of the pledged stock fell, lenders demanded additional cash to cover the shrinking collateral, and investors who couldn't produce that cash on short notice were forced to sell, often at whatever price was available in the moment, regardless of how far below intrinsic value that price had already fallen. Those forced sales pushed prices down even further, triggering yet another round of margin calls for the next group of leveraged investors, in a self-reinforcing spiral that turned an already painful downturn into something considerably more severe than it might otherwise have been. The investors who came through that same collapse in the best shape, relatively speaking, were disproportionately the ones who had never leveraged their positions in the first place, who had bought only with money they could genuinely afford to have tied up for years if necessary, and who therefore never faced a lender's deadline forcing their hand at exactly the worst possible moment. Their portfolios still fell in value, often severely, right alongside everyone else's. But because nobody could force them to sell, they retained the one asset that mattered most in that entire crisis: the ability to simply wait patiently for a recovery that eventually arrived. There's a story worth telling here about what it actually feels like to act on this philosophy in the middle of genuine crisis, rather than reading about it comfortably in hindsight, once everyone already knows how the story ends. During one of the more severe financial crises of the last several decades, when major well-known financial institutions were collapsing or teetering, when headlines carried genuine dread rather than manufactured excitement, when even seasoned professionals were uncertain how much further prices might fall, a small number of patient, well-capitalized investors began quietly buying stakes in fundamentally sound businesses at prices that by any careful measure of intrinsic value represented an enormous margin of safety. This wasn't a comfortable or obviously correct decision in the moment. Prices in some cases kept falling further for a while after these purchases were made, meaning the immediate, short-term experience of following this discipline was watching a paper loss deepen even further, with no way of knowing in real time exactly when the bottom would finally arrive. Friends and colleagues, watching the same headlines, openly questioned the decision, some with genuine concern, some with a kind of nervous disbelief that anyone would voluntarily buy into what looked at the time like a system unraveling in real time. There was no applause for buying during that stretch. There was, if anything, a fair amount of quiet skepticism, even from otherwise sensible people who simply couldn't separate the terrifying headlines from the actual, ongoing earning power of the specific businesses being purchased. What separated the investors who could tolerate that discomfort from the ones who couldn't wasn't superior information. Everyone was reading the same terrifying headlines. It was a genuine, internalized belief in the distinction between price and value, strong enough to survive the very real, very uncomfortable experience of watching a position they just bought keep dropping for weeks or months afterward. Years later, once the crisis had passed, and prices had not just recovered, but climbed well beyond their pre-crisis levels, those same purchases looked, in hindsight, almost obviously brilliant. They did not feel obviously brilliant while they were being made. They felt like exactly what they were: a calculated bet, grounded in patient arithmetic, made in direct defiance of Mr. Market's loudest, most convincing despair. There's a final piece worth naming, because it reframes something that terrifies most new investors into something closer to an opportunity, if you can train yourself to see it that way. Market downturns, corrections, even full-blown crashes are not signs that the system is broken. They are Mr. Market at his most despairing, offering you his share of real, functioning, earning businesses at a steep discount, purely because his mood has soured, not because those businesses have suddenly stopped being valuable. For an investor with a genuine margin of safety mindset, and a long enough time horizon, and an automated process that doesn't require daily emotional courage, downturns aren't catastrophes to be feared. They're some of the best buying opportunities that will ever present themselves, precisely because so many other people infected by the same despair Mr. Market is exhibiting are doing exactly the wrong thing at exactly that moment. There's a practical habit worth naming that ties several of these threads together into something you could actually implement rather than just admire in the abstract: the annual checkup, rather than checking a portfolio daily, weekly, or even monthly, which, as we've discussed, tends to invite exactly the emotional reactivity this philosophy warns against. Many disciplined investors settle into a rhythm of reviewing their holdings just once or twice a year on a fixed schedule, regardless of what the market happens to be doing at that particular moment. That review is when rebalancing happens, when contribution percentages get reconsidered in light of a raise or a life change, when the overall mix between stocks and bonds gets nudged slightly more conservative as retirement draws a year closer. Everything else, the other 360-some days of the year, the process simply runs on autopilot, untouched, regardless of what headlines happen to be screaming in the meantime. This rhythm accomplishes something subtle but important. It gives the investor exactly enough contact with their own finances to stay informed and to make necessary periodic adjustments without giving them so much contact that every daily fluctuation becomes an invitation to react. It's a designed compromise between total neglect, which carries its own risks, and obsessive daily monitoring, which this entire philosophy suggests is actively harmful to most people's long-term outcomes. An annual checkup, done consistently, year after year, tends to produce calmer, more disciplined behavior than either extreme, precisely because it limits the number of opportunities Mr. Market's daily mood ever gets to become the investor's own mood. There's something almost calendar-like about how this habit tends to work best in practice. Some investors tie their annual checkup to a birthday, a new year, or the start of a new tax year, something fixed and memorable enough that it happens reliably without requiring a fresh decision each time about whether now is the right moment to look. The specific date matters far less than the fact that it's fixed in advance, immune to whatever Mr. Market happens to be feeling on that particular day. A checkup that happens to land in the middle of a severe downturn isn't cause for alarm or a reason to reschedule. It's simply the appointed moment for a calm, unemotional review of whether the underlying plan still makes sense, guided by the same principles that shaped it in the first place, rather than by whatever fear or excitement the calendar happened to serve up that year. There's a modern wrinkle to all of this that deserves its own moment, because it didn't exist in quite the same form 100 years ago, and it makes the entire discipline of ignoring Mr. Market's daily mood considerably harder than it used to be. Financial news in the modern era is constant, available every minute of every day, delivered straight to a device sitting in your pocket, and it is almost by design built to make you feel like today's price movement matters urgently right now in a way that demands your attention and probably your action. A calm, boring day where prices barely move doesn't generate much interest, so financial media rarely covers those days with the same intensity. A dramatic drop, a surprising surge, a breathless headline about an industry's future, that's what draws attention. That's what gets shared. That's what keeps people watching. And none of it, almost by construction, is designed with your long-term margin of safety in mind. It's designed to capture attention, and attention is most reliably captured through urgency and emotion, which happen to be exactly the two things a sound investment process is trying to protect you from. This creates a strange paradox worth sitting with. The easier it becomes to check prices constantly, the harder it becomes to actually behave like a patient, disciplined investor, because the temptation to react to every fluctuation grows right alongside the ease of seeing those fluctuations in real time. A defensive investor a century ago might have checked their portfolio's value a few times a year, receiving a printed statement in the mail. A defensive investor today can check a number on a screen dozens of times a day if they choose to, and every single one of those checks is an opportunity for Mr. Market's mood of the moment to become their own mood, however briefly, however unconsciously. Consider the specific experience of a single ordinary trading day, one with no major news at all, where a broad index simply drifts down by a small, statistically unremarkable amount. The kind of daily fluctuation that happens constantly and means essentially nothing over any meaningful time horizon. An investor who happens to glance at their phone during that ordinary day sees a red number, a small dollar figure representing the day's decline, and even though the rational, informed part of their brain knows this is noise, utterly unremarkable in the broader scheme of decades of investing. A different, older, more instinctive part of the brain registers it as a loss, an actual tangible loss worthy of at least a small twinge of anxiety. Multiply that twinge by dozens of casual glances a day, hundreds of trading days a year, and the cumulative emotional toll of constant monitoring becomes considerably larger than the constant monitoring ever actually justified, given how little any single day's fluctuation typically means for a genuinely long-term investor. One of the more practical, almost mundane pieces of discipline this whole philosophy quietly demands in the modern era is simply this: check less often. Not because ignorance is a virtue, but because frequent checking for most people produces more anxiety than insight. And more anxiety produces worse decisions almost without exception. There's a quieter cost to all that reactive buying and selling worth naming as well, one that rarely shows up in the exciting part of the story, but eats away at returns just as steadily as any market downturn. Every time an investment is sold at a profit, in most ordinary taxable accounts, a portion of that gain typically becomes owed to tax authorities, and the specific portion owed often depends on how long the investment was held before being sold. Frequent trading, chasing whatever story happens to be exciting this month, and abandoning it for the next one, doesn't just expose an investor to the emotional whiplash of Mr. Market's mood swings, it also tends to generate a steady stream of taxable events, each one quietly shaving a little more off the final outcome, compared to an investor who simply buys good, diversified holdings and lets them sit, untouched, for years or decades, only rarely triggering a taxable sale at all. Patience in this specific sense isn't just an emotional virtue, it's a direct, measurable, mathematical advantage, sitting quietly alongside all the other advantages patience already provides. There's a related idea worth naming, because it explains something that puzzles a lot of people the first time they encounter it. Why do individual investors, on average, tend to underperform the very investments they hold? It sounds almost like a contradiction. If someone owns a fund that tracks a broad market index, and that index goes up a certain amount over a decade, how is it possible for the average investor in that exact fund to have earned less than the fund itself returned over the same period? The answer, again and again, in study after study across different markets and different decades, comes back to timing driven by emotion. Investors in aggregate tend to pour money in after prices have already risen, chasing performance that's already happened. Infected by exactly the euphoria this whole philosophy warns against, and they tend to pull money out after prices have already fallen, fleeing exactly the despair this whole philosophy warns against. The fund itself might have simply sat there, quietly compounding over the decade. The average investor in that fund, buying high and selling low along the way, captured only a fraction of what patient, unmoved ownership would have delivered. Let's turn to bonds for a moment, because they get mentioned throughout this philosophy almost as an afterthought to stocks, and that undersells how much work they're actually doing inside a well-built defensive portfolio. A high-quality bond isn't chosen because it produces exciting returns. It usually doesn't, and it was never meant to. It's chosen because it produces a cushion, a stabilizing counterweight to the far more volatile behavior of stocks, and because that stability creates something psychologically valuable that a pure stock portfolio can't offer on its own: the ability to rebalance. Here's what rebalancing actually means in practice. Suppose a defensive investor decides, once at the outset, to hold something like 60% stocks and 40% bonds. Over a year where stocks climb sharply, that original 60-40 split drifts, maybe to 70-30, because the stock portion has grown faster than the bond portion. Rebalancing means periodically selling a slice of the stocks that have grown and buying more of the bonds that haven't to restore the original 60-40 target. Notice what this mechanically forces the investor to do, without requiring any prediction about the future at all. Sell some of what has become relatively expensive and buy some of what has become relatively cheap. It's a built-in, almost automatic version of buying low and selling high, executed on a schedule, requiring no forecasting whatsoever, simply because the math of maintaining a target ratio forces the behavior on its own. The reverse happens just as usefully during a downturn. If stocks fall sharply, that same 60-40 portfolio might drift to 50-50, with bonds now representing a larger share simply because they held their value while stocks didn't. Rebalancing back to 60-40 means selling some bonds and buying more stocks right in the middle of the downturn, exactly when Mr. Market's despair has made stocks cheapest and exactly when instinct is screaming the loudest to do the opposite. The rebalancing rule doesn't care about instinct. It just executes the math, and in doing so, it manufactures exactly the buy-low behavior that so many investors, left to their own emotional devices, find nearly impossible to execute on their own. The specific 60-40 split used in that rebalancing example is just an illustration, not a fixed rule, and it's worth addressing directly how that split might reasonably shift across a lifetime. A younger investor, decades away from needing their savings, can generally afford to lean more heavily toward stocks, precisely because time horizon offers the patience needed to ride out even a severe downturn without being forced to sell at the bottom. As retirement approaches, and the money in the portfolio starts to matter for near-term living expenses rather than distant future ones, a more conservative mix leaning further toward bonds tends to make more sense. Trading away some long-term growth potential for a meaningfully smaller chance of a severe downturn arriving at exactly the wrong moment, right when income is needed most, and there's no more time left to simply wait for a recovery. There's no universal formula that fits every person's specific circumstances, income needs, and appetite for volatility. And anyone claiming there's a single perfect ratio for every investor at every age is oversimplifying something that genuinely depends on individual circumstances. But the underlying principle holds regardless of the exact numbers chosen. The mix between volatile higher growth assets and stable lower growth ones should generally shift gradually over a lifetime, becoming somewhat more conservative as the time horizon for needing the money shortens. Not because stocks become more dangerous with age, but because the investor's capacity to patiently wait out a downturn shrinks as the need for that money draws nearer. Some investors find it helpful to think of this shift the way a ship's captain might think about approaching a harbor after a long voyage. Far out at sea with plenty of open water and plenty of time, a captain can tolerate rougher weather without much concern, simply riding it out, confident there's room and time to correct course. Close to the harbor, with land and obstacles nearby and far less room for error, the same captain slows down, becomes more cautious, and leaves far less to chance. Nothing about the ship or the ocean itself has fundamentally changed. What's changed is the proximity to the moment when precision finally, unavoidably matters. There's one more risk worth naming before we bring this all together, because it's a quiet one, easy to overlook precisely because it doesn't announce itself with a dramatic crash the way a stock market downturn does. Inflation, the slow, steady erosion of what a fixed amount of money can actually buy over time. A pile of cash sitting untouched in a low-interest account might look perfectly safe, might never show a single day of dramatic loss the way a stock portfolio can, and yet it can still lose enormous amounts of real purchasing power over a decade or two simply because prices for everything else keep rising while the cash itself does not. This is a different kind of risk than the sudden visible risk of a market crash, and it's arguably more dangerous specifically because it's invisible, day to day, only becoming obvious in hindsight. Once someone realizes their supposedly safe pile of cash buys dramatically less than it used to. Stocks over long stretches of history have tended to outpace inflation by a meaningful margin, which is one of the more counterintuitive reasons a defensive investor still holds a meaningful allocation to them despite their short-term volatility. The volatility is real and uncomfortable. The alternative, treating cash as risk-free over long time horizons, carries a quieter, slower-moving risk of its own. Picture someone who decades ago set aside a meaningful sum fully intending to keep it perfectly safe, and simply left it sitting in a low-interest savings account rather than investing any of it precisely because they wanted to avoid the discomfort of watching a stock portfolio's value bounce around. On paper, that decision looks conservative, even prudent. In practice, decades later, that same sum, adjusted for how much everyday goods and services now cost compared to when it was first set aside, has lost a substantial portion of its real purchasing power, even though the number printed on the account statement never once went down. The nominal number stayed flat or grew slightly. The real number, measured in what that money can actually buy, quietly shrank the entire time, year after year, without a single dramatic headline ever announcing the loss. This is exactly the kind of risk that never shows up as a scary chart, and precisely because of that, it tends to go unnoticed by the very people it harms the most. There's one final reframing worth sitting with before we close, because it answers a question that tends to nag at anyone hearing all of this for the first time. If this philosophy is genuinely this effective, and it has been publicly known and taught for the better part of a century, why hasn't it simply stopped working? The way most easy edges in a competitive market tend to get arbitraged away over time as more people catch on and exploit them? The answer is almost strange in its simplicity, and it circles back to that early distinction between technique and temperament. The specific techniques in this philosophy, reading financial statements, calculating a rough estimate of intrinsic value, comparing that estimate to price, are not secret. They've been published, taught, and repeated for generations, available to absolutely anyone willing to read a book and put in the effort. If the edge here were purely informational, it would have vanished decades ago, the moment enough people learned the technique. But the edge was never really informational. It was behavioral. The actual difficulty was never understanding the concept of margin of safety. It was living through an actual real-time market collapse, watching your own account balance fall by a third or more, watching headlines scream that this time really is different and things really might not recover, and still holding steady, or better yet, still buying because your process told you to rather than because it felt remotely comfortable to do so in that specific moment. That kind of temperament turns out to be far rarer than the information required to understand the underlying arithmetic, and it can't be taught the same way arithmetic can. It has to be built slowly, often through direct experience of at least one real downturn, ideally survived using the discipline rather than abandoned partway through it. This is why the edge has survived for nearly a century of widespread publication without being competed away. Everyone can read the book. Very few people can actually behave the way the book describes when it matters most, which is exactly why the discipline keeps working for those who genuinely internalize it, decade after decade, market cycle after market cycle, long after the specific numbers and examples from any particular era have become outdated footnotes. If any of this is landing, the idea of a market that's really just a moody business partner, the discipline of buying only with a real margin of safety, the quiet power of refusing to let daily price swings become daily emotional swings. There's a lot more of this waiting for you. Full-length narrations on money, markets, and the psychology behind both, built to play in the background while you're doing anything else at all. Search Money Files audiobooks and let the next one run quietly while you go about your day. The same patient, unhurried way real wealth actually tends to get built, because that's the thread running through this entire story, from the very first page to the very last. Mr. Market will keep showing up every single day in every mood imaginable, offering you a new price and a new story to go with it. He was never asking you to predict him. He was never asking you to outsmart him. He was only ever asking whether you had the discipline to treat his mood as information you could use rather than an emotion you were required to catch. Think back to where this all started. That image of a business partner showing up at your door with a different mood every single day. Sometimes generous, sometimes despairing, always certain that whatever he's feeling in the moment is the correct, final assessment of the future. He'll be back tomorrow, and the day after that, indifferent to whether you paid attention to him yesterday, indifferent to whether his mood swings ever cost you anything, because he was never a malicious character to begin with. He's simply a mirror, reflecting the aggregate anxiety and excitement of an enormous crowd of other people, most of them reacting to the same headlines, the same fears, the same fleeting stories, in real time, without the benefit of the patient arithmetic this whole philosophy is built around. You don't have to out-argue him. You don't have to predict him. You just have to remember every single time he shows up at your door with a new mood and a new offer that his mood is information about the crowd, not a verdict about the value of what you actually own. That one small act of remembering, repeated patiently over years and decades, is very nearly the entire philosophy distilled down to its simplest, most durable form. The investors who did best across a century of market history weren't the ones who guessed correctly more often than everyone else. They were the ones who built a process sturdy enough that guessing correctly stopped being necessary at all, and then simply let that process run, patiently, year after year, while Mr. Market carried on with his moods entirely on his own.